if anybody's learned about time value of money, a dollar saved today that we're able to reuse in our business or our real estate is worth more than having that dollar over those 39 years. If I'm able to accelerate the depreciation and speed up the amount of expenses I'm able to take, I'm saving more money in taxes this year that I can use to reinvest in my business or real estate.
What's up, everybody? My name's Mike Sjogren, here with my co-host,
Emmanuel Pani.
We're part of a group of specialized real estate investors you've probably never heard of.
We didn't start with deep pockets or wealthy families, and we don't rely on 401ks, mutual funds, or traditional real estate investing.
In fact, many of us don't even own the properties that fund our freedom. If you ask the money experts out there, they'd say what we do is impossible, yet it's happening every single day.
It's happening through a new niche called short-term rentals.
We are Short-Term Rental Nation, and these are our secrets. What's going on, STR Nation? Welcome back to another episode of the Short-Term Rental Secrets podcast. I'm your host, Mike Sjogren, here with my main man and brother from another mother, Mr. Emmanuel Pani. What's up, B?
My brother, I get to see you in like less than 2 weeks.
Dude, I'm jacked.
10 days away. I can't believe it. Like, I can't believe that after all. So I think the last time we saw each other was Grant Cardone.
Was that seriously it? The last time we hung out in person? 2019?
2019.
Damn.
I was telling Tasha, because me and Tasha were talking. I was like, dude, I'm so excited to go to Nashville. And I'm like, dude, when is the last time I saw Mike? I'm like, is that when he came down? She's like, no, there's no way. I'm like, I don't think I've seen him since.
Yeah, dude, that's wild. It doesn't feel that long, but I guess because we Zoom all the time. But
we do Zoom a lot, yeah. But I'm super excited. Life is good. We are launching a property for a client on Friday. I am going to a final walkthrough and a closing after this for another client. I am trying to find our good friend Tim a house. I'm going to have to start charging him for my extra therapy sessions that I'm going to just to deal with him.
He texted me the other day. He's like, I feel like I should throw E like a couple grand just because I think I'm driving him nuts. I'm like, you probably are, but it's kind of comes with the territory. So.
It does come with the territory. And it's just like, at the same time, it's just like you love all your clients, but then you realize you're like, oh my God, there are some people that are just so intense. And when you're not used to, like, my last couple of clients have been very mellow. And so the attention that he needs for a very more intense client and like having to like raise my energy to match his, it's exhausting. And that just goes back into like, you know what I mean? Like, especially if you're in sales, that ability of like mirroring and like matching your clients, it's super important. But when you get out of practice, or if you start working with the same kind of clients over and over, to be able to shift gears has been fun. But life is good, man. What about you? Other than the fact that you have the biggest event of your life just 9 days away, what else is going on?
We've got our first guest checking in today for a unit we just launched out in the Hamptons in New York. So It's our first one out there. So it should be good. And then I got a text from Matt from my team got a text from that owner. Hey, 3 of my buddies, I was telling them about you guys. They want you guys to run their properties too. So might turn into 4 units in the Hamptons. We'll see how that goes.
Nice.
But yeah, man, other than that, it's really just been prepping for this. I actually was just about to send Bill and Chris my presentation. So pretty pumped for that. And then I've got Caden's kindergarten graduation next week, which will be fun. Yeah, he's getting big, dude. He's ready for the big leagues now.
Yeah. Look at him. He's playing baseball. He's graduating kindergarten. Before we know it, he's going to start going out with girls on dates.
Yep.
Calling Uncle Tim to get his Ferrari, hopefully, because that's, you know.
Tim came over with the Ferrari last week, and Caden could have cared less. I was like jacked up. He let me drive it, and Caden could have cared less. I'm like, all right, man, whatever.
Hey, there you go. Good. Maybe he's into other things, you know?
Yeah. 100%. But I'm pumped for today. So today we've got a special guest who's actually going to be speaking at the conference. And if you've been living under a rock, what we're talking about is the Short-Term Rental Wealth Conference. It's June 6th to the 8th in Nashville. So we've got 2 full days plus a badass welcome party the first day. Some amazing speakers from all over the world. I'll be there. E will be there. Bill Faith, our guest that I'm about to announce, will be there. and it's going to be a blast, man. Like I'm super pumped. This has been a long time coming. So, but anyway, today on the show, we've got Ryan Bakke with us. So he's a real estate CPA. So he's a tax guy, but he's also an investor, right? And I think this is really important because he owns STRs and he owns multiple businesses. So he looks at things like through our lens, like he's in alignment with us, right? And it's super helpful because there's a lot of CPAs, a lot of attorneys, a lot of different people in that professional space, but not a lot of them own property and own STRs and look at it through the same lens that we do. And Ryan's kind of like the go-to guy for all this stuff. So super pumped to have him. Let me bring him up. What's up, Ryan? Welcome to the show, man.
Hey, Michael, how are you doing?
I'm good, man. I'm good. How are you?
Pretty good today.
Yeah, today's a good day.
Every day is a good day, man.
Yeah. I love it. I love it. So why don't we just bring it back and kind of like talk about your background? I mean, you're a fairly young guy, but you've accomplished quite a bit. So like, let's bring it back. Like what got you into the real estate and entrepreneur, like business ownership game and kind of where you're at now?
Yeah, so in college, I studied accounting and finance. I did a double major and then a minor in real estate. And it wasn't until I was working in college when I was preparing tax returns. And that particular day, I did a return for a married couple that made $200,000, just run of the mill W-2. And then I did a tax return for a guy who owned, it was about 18 apartment buildings in Chicago. And he made 400 grand in cash flow from real estate, and he was single compared to the married couple that made 200 grand. He paid less in taxes than the married couple who made half as much as he did. And so I'm sitting here pondering, and I asked my boss, I say, how is this possible? How does this work? He goes, it's because he invests in real estate. And ever since then, I've been trying to put the pieces together of just, how does this guy do this? I need to do this. I need to work with people who want to do this type of tax strategy. And I've been spending the last few years of my life doing that, just helping people, buying properties myself, looking to acquire, just put an offer on a property yesterday, actually, and just trying to scale real estate. So got the business activity going where I help people with the tax strategy. And then I also acquire properties on my own or with partners.
Love it, dude. And you've got some other business, don't you, as well? Is it like a laundry?
Yeah,
or something?
I just invest in pretty much anything that cash flows, but cash flow businesses that work well, hair salons, laundromats, anything that's in my area, I'll try to invest in.
Okay.
Yeah.
Interesting, man. Interesting. I don't think we've had anybody on the show that invests in like salons and laundromats. So just out of curiosity, how does that work? Like, do you go and buy it or do you own a percentage of it? Like, is it almost like a syndication partnership?
Yeah, percentage.
Okay,
yeah.
Cool.
There's no day-to-day. And that's what we'll get into maybe in a little bit is that's the beauty of being like a passive investor or what we call like a limited partner is if you're not involved in the day-to-day, it becomes a passive activity to you. And therefore, and all passive activities offset each other, which means I can take losses that I have from maybe my multifamily houses and use those losses to offset the income that I might have from my limited partnership interest in a hair salon or a laundromat. And what I'll talk about at the conference, and maybe we'll get on to today's show is if you look at a tax return, any rich and wealthy person, they don't have any money coming in from the W-2 line. They have all their income that's coming in from passive activities, real estate, that bucket of activities that are going to be able to allow you to offset that income with losses.
Gotcha. So in layman's terms, rich people basically don't have jobs.
Don't work for money.
Yeah.
The rich don't work for money. Yeah.
So again, for somebody that's not familiar with like tax stuff, or this sounds like super foreign to them, I guess let's talk about like active versus passive income real quick, just so that they get a general sense. So like active income, like W-2, if you're a contractor, where's the line with STRs? Because that's the gray line that everybody talks about, especially in the professional world.
Yeah. So active income is going to be pretty much anything that you work for. So if you're a W-2, maybe you're a 1099 contractor, that income is also going to be subject to what's known as FICA tax. I call it the F word, but it's Social Security and Medicare. So if you look at your W-2 pay stub, you'll see a little line that says Social Security and then a little line below that says Medicare. That's like a working man or woman tax that you have on wages or earned income. When you shift over to the passive bucket, so by default, all rental real estate, so not just STRs, but long-term rentals, commercial buildings, any rental real estate, not co-hosting income. Co-hosting income is active. I'll mention that, but any rental real estate where you actually own it, it's considered passive income. So the first step there is passive income does not have that FICA tax, that F word. So right away, any dollar that you earn through real estate, you're going to save more in taxes compared to if you earn that dollar through your day job, because you're not going to have that FICA taxation, the Social Security and Medicare. But even further, when we talk about, hey, how do I offset my income? Well, if you're just a W-2 run-of-the-mill employee, there's limited things that you can do to offset your income. You got retirement accounts, health savings accounts, having more babies. That's really it that you can do from if you're just a W-2. But if all your income is coming from that passive bucket, when you start having more streams come from rental real estate, whether it's, again, short-term rentals, long-term rentals, commercial, there's so many things you could do on that bucket, that side of things, to offset your tax liability that the regular W-2 person can't.
Okay. What are some examples, and I want to save the depreciation one for after, but what are some other examples that you've seen, I guess, that people can write off through a business to bring that taxable income down?
We have to think about everything that goes into running a business, right? You might have to use your phone, your internet, your Wi-Fi to communicate with people. I have to use my home, part of the resources in my home, like a utility bill, property taxes for offices that you might own. Same thing with real estate property, right? You paying property taxes, mortgage interest. You're going to be able to deduct those type of things. Anything that's ordinary in that business. So your contractor fees, supplies, furnishings to get it started, everything's deductible as long as it's ordinary and necessary to the business.
Okay.
Mm-hmm.
And then I know my favorite is depreciation, but why don't we talk about that for a second? Because it's kind of like a fake expense that
Sure
you can kind of take.
Yeah.
Or it doesn't cost you cash.
Yeah. So depreciation is, I would say, the government's way of paying you back over the period of time. And so you could think of it as like a loan. So if I bought, let's say, a $390,000 property, and depreciation for short-term rentals is 39 years. So if I do 390,000 divided by 39, that's 10 grand a year that I get to drop on my profit and loss statement for tax purposes. So maybe let's say my rental property cash flows 30 grand. Okay. But I get $10,000 of depreciation. I get to tell the IRS that I only made 20 grand because I have that depreciation amount there. So it is a phantom expense that I don't have to come out of pocket for, but it's recouped over the life that I hold on to that property. So in that case, I get 10 grand every single year for 39 years to go against my profit and loss.
I want to talk about accelerating that, but first, you brought up the point of co-hosting, and I get this question all the time.
And arbitrage too. You should talk about that.
I was gonna say, let's hit on that. Like arbitraging and co-hosting is not the same as owning the asset. So how does that work for write-offs and active versus passive?
Yeah, so the co-hosting income and the arbitrage income is going to go in the active bucket. So the only thing you're going to be able to really write off there is going to be your expenses that you incur for that co-hosting income. So computers, equipment, phone, right? Any cost that you have in that bucket, but you're not going to get that gem of depreciation to go against your income. And furthermore, right, it's going to be active income subject to that FICA tax, that working man tax that I talk about.
Mm-hmm.
So
okay.
To sum it up, you earn $1 in co-hosting, you're paying more in taxes than if you earned $1 if you owning the actual property.
Yep. So let's talk about accelerating that depreciation, right? Being able to take more of that sooner. So I know you said technically short-term rentals are considered commercial, which means instead of 27 and a half years, it's over 39, right? So
yeah,
it takes longer for you to recoup that, but let's talk about like cost segregation studies.
And that's why it's important, and you see it a lot more in the commercial and the short-term rental side of things. It's because it's 39 years as opposed to 27 and a half. So there's already that added incentive to want to speed speed things up. When I said the depreciation is almost like a loan, it's a loan in the sense that you can almost decide how you want to take it. So if you accelerate the depreciation on it, instead of getting 10,000 that first year, I might get 70 or 80,000 that first year. But the remaining years, I'm going to be getting maybe 5 or 6 grand a year as opposed to 10 grand a year. But it's that first year where I'm putting the asset in service, where I'm having my expenses, I'm getting income. I'm able to accelerate the depreciation on that to offset the income from that property. But also I might have other rental properties that are doing well too, that I can use that whatever loss I have remaining against my other rental properties, or a hair salon business that's passive to me, or a laundromat that's passive to me, right? So accelerating that depreciation, if anybody's learned about time value of money, a dollar saved today that we're able to reuse in our business or our real estate is worth more than having that dollar over those 39 years. If I'm able to accelerate the depreciation and speed up the amount of expenses I'm able to take, I'm saving more money in taxes this year that I can use to reinvest in my business or real estate.
And just to help people understand how this is possible, right? So if you looked at a piece of property that you own and say it's a $500,000 property and you've got 30 grand worth of furniture in it and you're depreciating and the land is worth 100 grand, right? You can't depreciate land because that doesn't go down in value and there's no repairs on or whatever. So we'll call it 430 grand that you can actually depreciate over 39 years. What the government is saying is basically like, it's basically giving you a little budget to like fix it up over time, right? But if you look at a house, some of that stuff is not going to last 39 years.
Correct.
Right. So with accelerating that depreciation, and Ryan, feel free to jump in here from a micro level, but at a macro level, it's like your couch is not going to last 39 years. It might last 5 years, right? So what a cost segregation study does is it goes and it breaks down all the different compartments of what's in that property. And then it's like, all right, well, this really can only last for 5 years. This might last 10 years, right? And so it lets you take all of those shorter ones and accelerate the depreciation on those.
Right. That's exactly right.
So what are the different buckets, Ryan, from a cost seg standpoint, like from a timeline of like, okay, this is a 7 years, a 10 years, a 3 year, like how do those buckets work?
We typically see for the majority of houses, they're either going to be 5 or 15-year property or 5 or 15-year assets. There's also 7-year assets. We don't see it as much. The 5-year assets are going to be pretty much anything inside of the property. So your furnishings, your cabinets, countertops. Your 15-year assets are going to be what are called land improvements. So it's anything that's structured on top of the land. So maybe you have a deck, a patio, a driveway. Anything that's sitting on top of the land is going to be considered a land improvement. And this is something I tell investors and clients too, is when you're looking at a property from a bird's eye view and you see a ton of land with decks and the whole 9 yards on top of it, your eyes should light up because you know that you can immediately write off that deck or that patio or that driveway or the fencing or a pool. Anything that's fixated to the land itself is going to be able to be depreciated in the first year.
Okay. So let's go a little deeper on that. What would go into the first year, like bonus depreciation? So like you said, decks, driveways, what else?
Decks, driveways, paver set, anything that's sitting on top of the land that's not the building itself.
Okay.
It's considered a land improvement.
So would it also be like if you have like a ADU unit or like a shed or like a separate garage that you have converted into an apartment?
If it's an ADU, most likely the ADU is going to be on a 39 year because it's producing rental income.
Got it.
Aside from the regular building, most likely. If it's a shed that's not being used as an ADU, it's going to be depreciated in the first year. But if it's an ADU that's producing rental income, odds are it's going to go on its own depreciation schedule.
Got it.
Yeah.
Makes sense.
So for the first year bonus depreciation, there's nothing inside, or is there stuff inside?
No, there is stuff inside. Yeah, it's going to be your 5-year assets. So again, like your cabinets, countertops, flooring. You're going to have the furnishings, lights. Most of the content that's inside of the building is going to be 5-year life.
Okay. So anything that's 5-year or 15-year can get accelerated into that first
Correct.
year?
Right.
Okay. Perfect.
Right.
Okay. So again, guys, the reason why this is so important is because if you do the math on that, and let's just say all that stuff adds up to $100,000 worth of stuff, and you get that 100K of depreciation up front, and you're at a 30% tax bracket, that just saved you 30 grand in taxes.
Right.
Like it adds up quick, especially as you start building your portfolio. So that's why like Ryan's talking at the conference about these different strategies, because this is how wealthy people get wealthy. Like they understand these strategies, and that's another 30 to 50K that you can roll into another deal. And then another one, and then offset the losses from some of your properties that are killing it versus maybe some that you got some extra bonus depreciation the first year. So when you can put all these pieces together and you work with somebody like Ryan that can map all this out for you, this is where you really start to generate great cash flow, and you can start to really multiply your portfolio quickly, because you're not just giving all that cash flow to Uncle Sam at the end of the year. And none of this is sketchy. This is all in the tax code. Like the government wants us to buy property. Like people need places to go, places to live, places to stay. Like they incentivize people to do this kind of stuff. So they give them tax breaks.
Yeah. And even if you're not looking to grow too rapidly, if you have a great W-2 income, this is a great chance for you to offset your W-2 income, right? That's why in our real estate syndication, when we buy apartment complexes, we do cost segregation study to offer to our investors, very similar for the same exact reason, right? We're like, hey, do you have a great W-2 job? Do you need to offset? We're doing a cost segregation study on this 29-unit apartment complex, this 80-unit apartment complex, and then they get to carry some of those write-offs in their taxes. And then, as Mike said, then they have more money to invest in more syndication. So it's kind of this like gift that's going to keep on giving. So I loved the beginning story, right? That it's kind of very much your very own rich dad, poor dad moment, right? That you're kind of looking at it, you're like, okay, I realize. So how did you go from that moment of like understanding to getting your first property, and what does that look like?
Yeah, so out of college, I actually worked at a consulting firm called Deloitte for a year and a half, and at Deloitte, I did.
Working there now.
Your brother's working at Deloitte?
He just started like 2 or 3 months ago.
Yeah, and so I was working at Deloitte, and I was doing investment management taxation. So we work with a lot of hedge funds, real estate syndications, investment banks, and I was helping people who are millionaires and billionaires get more wealthier. And I decided like I want to help the everyday person get rich and wealthy. So I started building it up on the side, reading as many books as I can. I bought my first house hack property while I was still there, and then eventually left to scale my own firm, because I was like I said, I was already helping rich and wealthy people get even more rich and wealthy, and I wanted to help the everyday person, people more like me, get rich and wealthy. So that's why I decided to leave, and here I am now, about a year and a half later.
I love Deloitte. Deloitte to me has that like empire kind of vibe. Like, what I mean? I have no idea, but I assume that everybody's like super, super corporate and walks around, and it's just the evil empire just helping richer people get richer. So I love that. So you have your company, right? And so what do your systems look like? Because obviously you're busy helping clients. So who's running your properties, or what kind of systems you have to run your properties?
I still self-manage my properties, just because I have maintenance crews come out sometimes for grass or things I can't get a handle on. But I manage all the properties I own now just because of cash flow reasons. Especially when you have managers of properties, it kills cash flow, especially on the short-term rental side, where they're taking like 15-20% gross. Until I get to a point where I feel like my time is better spent in my business and scaling that, rather than paying somebody 20% to run my properties, I'll move to that route. But for now, I still self-manage. But you brought up a good point, is the systems that are in play are essential, because you'll find yourself doing the same task over and over. I mean, if you can figure out how to automate that or streamline that process, that's what I noticed at Deloitte too. I was like, hey, I'm building processes and efficiencies at this company that if I did that for myself, I would make my job, my life a lot easier. And at the end of the day, it comes down to when you want to scale something, it comes down to your systems that are in play. Having the proper systems is going to allow you to scale faster.
So for right now, Ryan, are you using like a PMS and a pricing tool and all that stuff? Or are you just doing everything straight through like Airbnb or Verbo, or what are you doing now?
We're using pricing tools on newly acquired properties. When first started off, we didn't, which was a mistake. You should try to use a pricing tool because especially the pricing tool is an algorithm that's based on what's going on in the world, right? And if it knows something that you don't know, why would you not want to use that? So for example, like I was talking to somebody who I forget it was their place was in Miami or something, and they announced that this big event's going to be there. Well, like Price Labs is going to know that, and it's going to change the ADR for that particular day or weekend, you know. And if you're not keeping up on the day to day of what's going on in that area, you're going to miss that, and somebody's going to book your place at 30%, 40% less of what you could have got for it.
Mm-hmm.
Right?
Yeah, also because the thing with platforms that people need to understand is the platform don't care about how much money you make. So Airbnb is not going to have a thing that's like, hey, by the way, remember to raise prices for holidays, special events, local things, because Airbnb doesn't care. Airbnb just wants
Right.
you to list your space. But if you are under the assumption as a new host that they're going to have a thing be like, hey, let us show you how to make the most amount of money. Airbnb doesn't do any of that. You need to have a property management software that then plugs into a pricing software just to help you. And like, again, like it makes it so easy because it also allows you to do, as you scale, to do a change on a lot of different listings all at once. Whereas if you are doing it on Airbnb by yourself, you're going to have to go into every single one of them and change it by the week and change it by the date. And again, if you're trying to replace your income, wasting a bunch of hours doing something that can be automated by AI, it's really dumb.
So Ryan, what are some of the things that you're going to be covering in Nashville? I know you're going to be talking about some of this, but is it going to be in more detail, or what are some of the things that you got going on?
Yeah, so the presentation is going to start off just explaining what I kind of laid out earlier. Just the rich don't work for money, right? I had that on one of my slides, and it's the more income that you can get in the passive buckets of activities, whatever it is, right? For us, it's short-term rentals, but the more income you can get in that passive bucket of activities, the less taxes you're going to pay, the more cash that's going to hit your bank account, and over a period of time, you're going to grow wealthy and see what's called your effective tax rate decrease over time. So we're going to start off with that. We got a little bit more into the numbers when it comes to the depreciation. We're going to be talking about entity structuring for short-term rentals. We're going to be talking about strategies to exit properties and strategies to acquire properties. So it's going to be pretty good. Hopefully, I ran through it with Rachel's group a few nights ago, and I think I came out about 35 minutes. So I'd maybe slow down a little bit.
Nice.
I tend to talk fast when I'm presenting, you know.
Excited. Yeah.
Yeah, I'm just
Talking
excited.
tax code, you accountants get excited. Question for you. If somebody is listening to this and they have a bunch of little side businesses, majority of side businesses have an active component to it. So is there another business that people can do as a side business that would give them the same tax benefit that real estate has? Or is real estate unique in nature? Because in my mind, it is unique in nature, but I am also very limited by the amount of knowledge that I have, which is very small. That's why I ask you.
So there's only two types of passive activities. The first one is all rental real estate by default. So long-term rental, short-term rental, commercial, right? All rental real estate by default. And number two is any activity in which you don't materially participate, which means like if you're running co-hosting, you're participating in that business. It's not passive to you. But, you know, in my example or somebody else's example, If I take my money and I invest it in somebody's business and I don't make any decisions, I just sit back and I have a percent or ownership share, that's passive to me. So that's one of the two passive activities. Again, all rental real estate and any activity in which you don't materially participate in. So like a syndication is an example. When you get groups of investors, those GPs are going to be active in that syndication, but all your LPs are going to be limited partners. That's a passive activity to them. So then those LPs could be sitting there, and I have a few clients that do this where, they'll acquire a short-term rental, get it all fixed up, do bonus depreciation on it, and then the next year they're like, hey, I need a loss, but I don't want to go through the hassle of buying another short-term rental. So they're able to invest in, say, a real estate syndication that's going to do a cost segregation study and generate them a loss that they can use to offset the short-term rental. Again, all passive activities, they can offset each other. So you can have losses from one, income from another, and it'll offset each other. So those are the two types of. So
when you invest in a business, is there a percentage cap that you have to be under to be considered non-active, or as long as you're not active, if you have 49% of the business, as long as you're not doing the day-to-day operations,
right,
would qualify you?
Correct. Yeah. I mean, the more ownership percentage you have, I would say the more sketchier it looks, right? If you're like 99% owner,
the harder to prove also.
Yeah. But if you think of like a typical syndication, like the GP is going to be 30%, and then the LPs are going to make up 70% of that. Able it that, there's going to be maybe a dozen or 15 LPs, but the ownership percentage doesn't matter. It all comes down to who's the one making the decisions, and that's doing the day-to-day activities. The LPs are not. The LPs are just sitting back.
Got it. So the majority of the times, any side hustle that you do, unless you're investing in somebody else that is doing a side hustle and that's generating you income, is going to be considered active income.
Correct.
But by that token, then if you're somebody that wants to invest in somebody that has an arbitrage or co-host business, but you're not actively working on it, then that could technically qualify.
Correct. Yeah. So if you want to invest in Michael's arbitrage business, you could be a passive investor. You could say, hey, here's X amount of dollars. I'm not making any decisions. All that's happening is I want a percentage share in this business. I'm going to get cash flow from it. And you're considered a limited partner, right? Or you're considered passive. So then you could take the income that you get from Mike's business, your share, and have losses from your rentals and use those losses to offset that income. Pretty cool, right?
I think it's super cool. And like at the last time I had this conversation out loud with somebody, we were at a real estate conference, and we were sitting at a table with a bunch of guys from Go Abundance. We were like 6 or 7 of us. Everybody invests in real estate, and the waiter heard us talking about real estate. It's like, oh, I want to get into real estate. And we then got to the conversation about what we're talking about just now, which to me is crazy, and it makes you feel kind of bad in a sense. Was the realization in that moment that we're talking to the waiter, and the 8 of us that had a couple thousand units between all of us put together combined paid less taxes than the waiter.
You've heard the saying that what is it?
Which is messed up. But again, it's like Mike said, it's not illegal. It's just in the rules. So you just need to play by the rules, and like hire Ryan, you don't know what the rules are.
Yeah, Robert Kiyosaki said that there's 2 tax codes. There's one for the informed and the uninformed. Right. So there's one for the people that know what they're doing. What, like you said, and we've heard the saying that Warren Buffett pays less in taxes than his secretary. It's not that he actually physically pays less in taxes, but his effective tax rate, the amount of tax that he pays on each dollar, is less than her effective tax rate. And like I was saying before, the more you shift your ordinary or active businesses income to passive ventures, the less you're going to be paying in taxes over time, or you might pay nothing in taxes. Right. I just got off the phone with a guy today, mapping out how he can, buy 5 or 6 properties a year and pay nothing in taxes. Right. Just keep acquiring property, keep depreciating them, pay nothing in taxes, and keep the ball rolling.
And the thing with real estate, and probably you'll talk about this at the conference, which is another reason why I love it, is that this game never ends, right? Because let's say that you're a normal investor and you decide to depreciate something over the 27 years. The moment I sell something after 27 years, I can do what's called a 1031 exchange, right? And then I can roll those profits. So I took advantage of the asset for however long I took it, and then I rolled those profit into more real estate. And so that's why the cycle of real estate never ends. Because technically you can then create assets where you pay no taxes and they give you depreciation, so you're paying less taxes and other things, and then it just keeps on rolling, and then until you actually decide to sell something.
Yeah, every stage of the game, like real estate trumps any other asset class from a tax perspective, and I think a wealth building perspective too. Like, when you buy it, you're able to accelerate the depreciation, right? But that cash flow that you receive in that year, there's no FICA tax, right? So automatically you're paying less than the guy who's working a W-2. And then as that asset grows over time, you have the appreciation on that. What do we do with that? Well, we can cash out refinance, maybe not now because interest rates are super high, but we could take out HELOCs against it. So as that asset, maybe, let's say we buy a $500,000 building, we've accelerated the depreciation on it. We've got a tax benefit there. As that asset climbs in value, let's say our $500,000 property, if you're in the Smokies, that $500,000 property is like 1.5 million 2 years later. Now that asset's 1.5 million. Well, how do we tap into that appreciated value? If we sell it, we don't have the asset anymore, and we have a tax bill. But we could refinance or take a HELOC out against that appreciated value. That's not a taxable event, right? And then when we ultimately go to sell it, if we sell it outright and don't do anything fancy, it's just a 15% capital gain or 20%, right? A long-term capital gain. But like you said before, is now we're on that exit plan, we can exchange that for a different property. So every single step of the way could be non-taxable if you play your cards right. And I truly mean it. Like if you're a full-time real estate investor, and when I say this, I mean you're not doing co-hosting or arbitrage, because again, that's ordinary income active. But if you're a full-time real estate investor, like paying taxes is optional if you plan right.
This episode to me feels like one of those like life hacking episodes.
It's a cheat code, man.
Yeah, it is the cheat code, right? And like the beauty of like, and he so like nonchalantly kind of said that is like, well, you can refinance and that's not a taxable event. So where you technically go, and this is my approach, and I do this every couple of years, is that your properties become an ATM. You just have to do withdrawals in
a cash-free ATM, right?
In a bulk, right? But like, every 4 or 5 years, you can like decide, okay, I'm going to refi this property, take this money out. And it's free money for the rest of your life.
Ryan, one last thing that I wanted to get to before we wrap up, and I know you talked to my mastermind group about this, but there's a lot of misconceptions and misinformation around the whole real estate professional designation and how you can offset, a lot of high earning W-2s, doctors, CPAs, attorneys, whatever profession that make a lot of W-2 income. If they qualify as a real estate professional with short-term rentals, they can offset their W-2 income with losses from those. But what are those criteria to meet that real estate designation?
So the term gets thrown out there. I'll try to keep it very simple. Real estate professional status only applies to people who own long-term rentals or commercial buildings. Okay. The loophole or the workaround is short-term rentals. So short-term rentals, where the average guest stays 7 days or less, you don't have to be a real estate professional. Okay. And what I mean by that is, so I'm a real estate CPA, but like the work that I do does not qualify as a real estate professional activity. So I'm SOL to take my long-term rental or my commercial building losses against my income. And so is every other doctor, nurse, attorney, you fill in the blank. Because in order to be a real estate professional, you have to prove that you spend more time in real estate than you do your day job. If you're working, a 40-hour-a-week job, you're not going to be able to prove that. You're going to have to work like 85 hours a week. The loophole is short-term rentals, because with short-term rentals, you do not have to be a real estate professional in order to take your losses against your W-2 or your 1099, you have to do two things. Number one is the average guest who stays at your property is 7 days or less. So if you add up the total amount of days that it's rented out divided by the number of unique stays, if that's 7.0 or less, you meet step number one. And then step number two is you have to prove, again, that you materially participate in that activity, in that rental property. So the way you prove that is you're going to be counting you're going to keep track of your time, the time spent getting it set up, hosting it, responding to guests, all that type of activities you have to keep track of, and you have to prove these certain hour requirements. I don't want to go through the hour requirements on the show. I did it in the mastermind though, didn't I, a little bit?
You did. We don't need to go that deep today, but there's a lot of misinformation about this out there. That's why I want to touch it.
So you don't need to be
mostly just a teaser for people to come to Nashville.
Which is insane, because for the longest time, if you're a doctor or a lawyer, like, you're not going to be able to take your losses from your rental properties and offset your W-2. But with short-term rentals specifically, you can be a nurse, you can be a doctor, you could be a CPA. As long as you check those boxes, you're going to be able to use your losses from your short-term rentals against your active income. And that's how you scale and build wealth, right? Because if I'm able to save $30,000, $40,000 in taxes, I'm able to put that as a down payment on the next property and repeat those same steps.
100%. So thank you for clarifying that. Again, that could be like a whole nother, which you did for my group, but we don't have time to do that on the show. But before we get into the last question, where can folks connect with you and learn more about you and see about working with you?
Yeah, I'm on Instagram. Let's see, Instagram, Twitter. I got a TikTok now. It's just at Learn Like a CPA. Learn Like a CPA. And then my website's also just www.learnlikeacpa.com. You can contact me, shoot me a DM, shoot me a question, whatever you got.
Love it. Or just come talk to them in Nashville in like 10 days.
Or come see me in Nashville, buy me some beers and stuff. I'm fasting for Nashville, so at least I'm trying.
Nice. So Ryan, the last question that we like to ask all of our guests is, what is your number one secret to success with short-term rentals?
People. I think it's really a people business. At the end of the day, we get paid in relation to the problems that we solve for others, right? If you think of any sort of job, it's like you're going to get a wage, or you're going to demand an hourly rate or a service that's equal to the problem that you can solve. And so if you're a better people person and you're a problem solver, you're going to demand a higher rate than somebody that's not good with people or problem solving. So at the end of the day, it's a people business. And the thing with real estate too is, like, it blesses everybody, man. Like, you got real estate agents that are getting paid, the title companies getting paid, the lawyers, the people who are staying in your properties are being able to use your property, right? You got contractors that are getting paid, accountants are getting paid. Everybody's getting paid in real estate, man, and it blesses everybody. That's why it's the best asset class.
Love it.
I love that. That was so good. And I also want to I think there is a level of knowledge that is necessary to talk about things that can be complicated in a very simple way. And the entire show, it was very simple for being a CPA. So first of all, I applaud you for that, because a show like this could have gotten really dry, and it was not, and it was actually really, really packed with a lot of great info. So yeah.
Awesome.
Appreciate it.
Well, congrats, Ryan, thanks again, man. Always enjoy catching up with you. Looking forward to hanging with you in 10 days or so.
Yeah.
And for the listeners, thanks again for tuning in. Love you guys. And we'll talk to you guys soon. Take care, everybody.
Okay.
Hey, STR Nation, if you enjoyed this episode, please make sure to hit that subscribe button and leave us a review. And in the comments, let us know what topics you want us to cover on upcoming episodes, and we'll make sure to get that in the books for you. And if you really want to learn how to launch, automate, and scale your short-term rental business, if you want to go deeper, then check out our free masterclass at strsecrets.com.